Hi everybody, and welcome back to the Luco Show. It's Monday, Easter Monday, the 13th of April. Happy Easter to everyone. Thank you, Jesus, for dying for our sins. I, hopefully, like many of you, I'm suffering from a serious sugar coma hangover today after the amount of Easter eggs I put away yesterday. But yeah, we're going to get on to a few different issues today. Firstly, we're going to start with our first ever Q&A, an unintentional Q&A, let's say, underneath the last video that I released, the Great Depression 2.0. We had a few different comments. There was a guy called Nobody, very clever name, made some nice comments there, so thanks very much. I appreciate the feedback. Billy Bob, James Renahan, Jimbo Smithy, thanks a lot for all getting in touch, guys. And Daryl Nelson asked a question relating to gold and silver. So we're going to start this video just after I give you quick contents of what we're going to cover with answering Daryl's question, and any subsequent videos that I have from here on in. I'll always start with answering any questions that anyone might ask underneath in the comment section of any of these videos. So yeah, then we're going to move on quickly to inflation and the inflationary effects that I think are going to impact the housing market. And I just want to look specifically at this, the idea of leverage trading and margin trading. It's a way in which you can effectively borrow funds off an exchange to bet effectively on, say, the stock market or cryptocurrency markets or precious metal markets or anything like that. And I just want to do a quick comparison with getting a mortgage, just to show you how risky in reality it is to actually sign your name to a mortgage, because I don't think that people fully appreciate what they're getting into whenever they're getting into a mortgage. And I want people to just check themselves, and it's okay to get into one potentially, but I want people to be fully aware of what they're getting into when they're in one, or if you're already in one, I want you to reflect and think about the position that you're in at the moment, because there are certain risks there that people don't typically realize nor discuss. And I think that short term, because of the short term effects that we're going to see in inflation, I think that we're actually going to see an all-time high in most housing markets around the world before the biggest housing market crash and stock market crash that there's ever been. So if you listen to this video and you're thinking about getting a mortgage, or you already have one, I think it's important for you to understand this concept of leverage trading and margin trading, how it effectively is the same thing that you're getting into whenever you get into a mortgage, because you're effectively getting enhanced gains whenever the stock market goes up, but whenever it unwinds and goes down and crashes, it's game over for you if you have a large mortgage. So yeah, important video. Right, Q&A. Daryl Nelson. I agree with your overall perspective. I'm curious why you think gold and silver will fall so drastically from here in the short term. Since we will see an increase in inflation over the next couple of years, would it not mean that metals move higher as well? Or are you thinking that once people realize the stock market's going back up and the crisis is past, they will move out of gold and into stocks? Okay, Daryl, you're a legend. Thank you very much for getting in touch. Inflation. Okay. We have something like 140 years worth of data in the United States, and in the region of 300 years plus worth of data in the UK, which shows us that an increase in the printing of money, in quantitative easing, an increase in the money supply on one hand, takes on average 2 years to have an impact on inflation. Now, that means that the monetary policy, the monetary measures that we've seen in the last couple of years, really, like, we're all familiar now with exponential graphs as a result of seeing all the C virus graphs over the last few weeks. An exponential graph kind of goes like this and this and this and pew, up through the roof. Now, what we've seen in terms of money printing over the last few years, months, weeks, we're starting to do this crazy exponential pump upwards, and that printing is only going to continue until we're fully squeezed into this hyperinflation type market and the whole market unravels. Now, we won't see. History shows us, historical data on average shows us that it takes 2 years for an increase in the money supply side to impact inflation. So we're not going to see the increase in the costs of goods and services until something like 18 months to 24 months down the line from here. And because we've seen hyper printing, the like of which we've never seen before, it's reasonable to assume that we will see hyper inflation in 18 months, 24 months type time. Now, the other side of things is that on average throughout history, an increase in the money supply side has initially just meant that more money sits in the average person's bank account, or the average business, or whoever it is that's been bailed out by that monetary policy measure at the time. It's only about 6 months after the money that it has been printed and the supply has been increased that we have typically reaped the benefits, the short-term euphoric buzz of the increase in the money supply. So we will start to see the benefits in about 6 months' time. And this is one of the main catalysts why I see there being a period of euphoria in stock markets, a period of euphoria in housing markets before an inevitable crash. I don't think, contrary to any mainstream media that you listen to at the moment that tells you, oh, we're in the recession now. Is it going to be a really bad recession? Is it going to be a depression? Or we're going to go much lower now? Fear, 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 fear. Anytime that you turn on the TV. Contrary to that popular belief, I believe that we're going to go to all-time highs in all stock markets around the world and likely all housing markets pretty much around the world. So I know that doesn't make sense whenever you look at the economy, but there is a massive disconnect in reality between the economy and between markets, like stock markets and housing markets and things like this. We, in my opinion, are just going to re-inflate the bubble that has been somewhat squeezed in the last few weeks, and we're going to inflate it much, much more. And then when it finally does burst in something like 18 months, 24 months from now, it will fully unwind. So, Daryl Nelson, to answer your question, why do I think gold and silver will fall so drastically here in the short term? Well, one, I think that because stock markets are going to go to all-time highs, the typical inverse relationship that it would have with gold and silver markets, I believe we'll see gold and silver naturally decrease. To your own point, are you thinking that people realise the market's going to go back up and the crisis is past, and will they move out of gold and into stocks? Yes, I do think that's going to happen, and unfortunately so for the individuals who are in gold and silver, because after this period of 18-24 months is up, I think that being in gold and silver will be the best place to be in the world when stock markets crash 80-90% over the next 10 to 15 years. Housing markets crash and do the same. Pretty much everything does the same. I think gold and silver will be the place to be. So the people that are going to get hurt the most, well, the people that are going to get hurt the most are the people who were in the stock market and just saw their wealth fall by like 30%, 40% over the last few weeks. They've since panicked, sold their shares at the worst time to sell their shares. They've now put their money into gold and silver, thinking that's the best place to be because things are scary and we're going to have a depression. And I actually think that gold and silver is going to tank now, so that's going to be the person that's impacted the worst. Kind of one of the reasons why I've made this channel. I want more everyday people to have at least a different opinion on what may unfold over the coming months, to the typical opinion that you'll hear if you turn on Bloomberg or CNBC, Fast Money or anything like that. In my opinion, these shows just give you a false idea of what's going to happen and end up with a lot of people losing whatever they have. So yeah, stocks are going to go up, so I think that'll push down gold. More than that though, retail traders, i.e. the average person who has got involved in gold and silver because of their uncertainty over the last few weeks, a couple of months really, they're effectively providing liquidity right now for bigger players to exit the market at these sustained highs. So if I look right now on TradingView at the gold price, it's currently trading just under $1,700 for an ounce of gold. If you notice, it was around 1,700 at a stage in February, around 1700 at a stage in March, and it's now around 1700. So people think that the resistance there is getting weakened and that we're going to push higher, but I believe that this is more than anything just an opportunity for bigger players to exit the market, and they're effectively selling their gold and silver to the average person who's going to end up getting burnt here as the price of gold tanks and the price of silver tanks over the next year or so. Anything else? No, I think that covers it for the gold and silver question. So I'm going to get on to inflation. Now, we've already obviously mentioned the impact of the money supply to inflation. I just want to bring up this one tweet from Peter Schiff. I give Peter Schiff a lot of grief because I think that you're not really doing people any favours if you're calling for a crash for 15 years and it doesn't come and doesn't come and doesn't come year after year after year while markets are going higher. I don't think you're doing anyone any favours by just batting that same drum the whole time whenever you're missing out on the biggest bull run of all time and things like this. But he's an incredibly knowledgeable man. I've learned a lot from him from reading different books of his and listening to different podcasts and things like this, so I appreciate the man. But he made this tweet, and he said on the 9th of April, he said, Fed Chair Powell has said the Fed will act until the economy is on the road to recovery. As long as the Fed is acting, the economy will never recover. The Fed will stop acting when either the dollar is worthless or when it decides that hyperinflation is worse than the alternative. When it decides that hyperinflation is worse than the alternative. I think that in a nutshell will be not the beginning of the end. I think that'll be pretty much the trigger to collapse the entire system. When people, not just the Fed, but when the average man and woman realise this printing thing has absolutely nailed us and we're beat. Because in 2 years, maybe less than 2 years, when we see the inflationary effects, the hyperinflationary effects of this hyper printing, that'll mean that our costs of goods and services are going through the roof to a fully unsustainable amount. I think that that'll be whenever people's mass psychology shifts and they understand that this money printing thing just is unsustainable. There is no such thing as a free lunch, as Milton Friedman would always say. Who is it that pays for this money printing? Is it the Tooth Fairy? Is it Santa? Is it the Easter Bunny yesterday? No, it's us. And we're going to end up paying and suffering the effects of it. So I thought that was an interesting tweet from Schiff. He's always right, his timing's just wrong. That's an important thing. Let me just see. Okay, we're just going to jump straight on to leverage trading and margin trading. If I want to buy a share in a company, British Telecom as an example, BT, its share price has tanked over the last few years. But if I wanted to buy, if I thought it was a good opportunity to buy shares in BT right now, say the share value was £1, I could just go and buy shares with my own money. Now what you can do, say I had £1,000, what I can do is I can go and buy £1,000 worth of shares. What I can also do, if I'm really, really confident and I'm really ambitious and I'm more willing to risk, let's say, I can go to any exchange, say IG.com, it's the one that I use, or basically any exchange, and I can say, look, I want to engage in leverage trading. And that basically means that, well, you can get up to 100 times your deposit in leverage trading platforms, which is insidious and insane. But more typically, people would do something in the region of 2 times, 3 times, 4 times, 5 times, even as high as 10 times. Which basically means that with my £1,000, instead of just buying shares, £1,000 worth of shares, I can put down a deposit of my £1,000 and they can lend me, say, 10 times as many shares. Sorry, the amount of money as to cover 10 times as many shares as my deposit was. So if I put down £1,000 as a deposit, I can leverage their services. I can use the money that they gave me and I can use 10,000, I can buy £10,000 worth of shares, or bet on £10,000 worth of shares in BT stock. So if it goes up in value, I actually end up gaining 10 times more than I would have if I just bought my own shares. Now, that in a nutshell is what leverage trading is, or margin trading. They call it margin trading because I can stand to gain 10 times as much on the way up in that example. I also theoretically can stand to lose 10 times as much on the way down. But once you get beyond your cutoff effectively once you lose, it goes down enough that you've lost the amount of your initial £1,000 deposit, the exchange just liquidates your position because they won't lose anything as a result. And what happens is you just effectively lose all the £1,000 that you put in the first place. So that's a way of getting involved with shares in a really risky way that can potentially have a massive upside, but the downside is you're incredibly overexposed, and if it goes down by 10% in that example, you'll lose all of your money. So in a nutshell, that's leverage trading, margin trading. Now, if I told that to the average person on the street, they would say, that sounds incredibly risky. That sounds incredibly dangerous. I'd never get involved in something like that. Now, the thing is, if you have a 90% mortgage on your house, you've put down the 10% deposit, you're effectively doing the exact same thing. You have got out leverage on the asset that is your house to the value of 90%, and all you've done is put down 10%. And the only, I actually don't understand how this phenomenon came about. But with the exception of the Great Recession in 2007, 8, 9, there's pretty much never been, since Richard Nixon took the US dollar off the gold standard in 1971, there's pretty much never been a time where the average man and woman, well, there's been a few recessions along the way, but for the most part, there's rarely been a time when we've seen a real crash in house price value. As a result, people think that it's kind of safe to get a mortgage in a house because prices always, if they don't stay plateauing, they increase over time. And that's not true. And I have to keep batting home this drum, but I believe it's going to be the biggest house market crash in the history of time in something like 2 years. So with that being the case, I really want people to really, really reflect and think about the mortgage that they're in. If people started losing their jobs in the city that they're in because of a financial crash, would the demand still be there? If credit was unwound and less easily accessible and interest rates increased, if interest rates increased from their all-time lows that we're at the moment, remember from our last video, the average UK base rate, minimum lending rate with the Bank of England since 1694, over 320 years, has been 6%, and we're currently at 0.1%. The last 10 years has been like a record low in the history of time by quite a bit. So if that inflation rate reverts to type and goes back up to 6%, the same average that there's been for the last 320 years, everyone's mortgage repayments are going to go through the roof. And if certain people can't afford to pay their mortgage repayment, and suddenly they have to default on their mortgage debt and their loans, and as a result of that, there's going to be such a knock-on effect. People start losing their jobs, businesses start closing, banks start stop lending as generously in terms of massive mortgages at such low rates. There's just this massive dominoes effect throughout society. And you have to ask yourself, am I fully engaged, or am I planning on getting engaged in this incredibly risky mortgage market where when you look at your neighbours and your friends and your relatives, nobody seems to realise that getting a house is this massive risk if you're engaging in what effectively is leverage trading if you're getting a mortgage. So yeah, house prices since the crash of 2008, in my opinion, have not recovered. Recovered is the wrong word. They have re-inflated. We're just in a different bubble, and the next bubble is just going to pop. So just something to think about. Yeah, that'll do for today. Enjoy the sunshine. While you have it, while we have it, we'll enjoy it. Comment under the video if you have any feedback, positive or negative. I'll always really appreciate it. And subscribe to the channel if you haven't. Share it. All the best. See you next week.